You walk into a mortgage lender's office with a credit score of 621. The loan officer pulls up your file, leans back in his chair, and tells you something you half expected to hear. You qualify. But the rate is going to hurt. Nearly 7% on a 30-year loan. On a $350,000 home, that rate will cost you over $180,000 more in total interest compared to someone with excellent credit. You ask if you can have 90 days to work on your score before locking in. The loan officer smiles politely. Credit scores move slowly, he says. A few months won't change much. 93 days later, you walk back into the same office. Your score is 761. The loan officer actually asks if you submitted the wrong social security number. You didn't. You simply learned about a mechanism built directly into the credit scoring system, one that most Americans never find out about. A mechanism that banks and credit card companies understand perfectly, but have zero incentive to explain. That 140-point jump saves you over $215,000 in lifetime mortgage interest. Same house, same income, same person, different knowledge. What you discovered wasn't a hack. It wasn't disputing accurate information or exploiting technical glitches. It was a legitimate feature of how credit scores are calculated, hiding in plain sight, while the financial industry quietly profits from keeping it obscure. Today I'm going to show you exactly what that mechanism is. By the end of this video, you'll understand why everything you've been told about building credit slowly over time is technically true, but practically misleading. There's a faster path. The system allows it, but nobody with a profit motive is going to walk you to the door. My name is Dave, and I spend way too much time thinking about credit systems, hidden financial rules, and the gap between what banks tell you and what they know. If you're someone who wants to stop paying more than you should just because the rule book wasn't handed to you, hit that subscribe button and give this video a thumbs up if it saves you real money. Let me start with the standard advice. The conventional wisdom on building credit is simple. Pay your bills on time. Keep your balances low, don't open too many new accounts, and wait. Wait years, wait decades. Let your credit history age like fine wine, and eventually your score will climb into excellent territory. This advice isn't wrong. It's just incomplete in a way that benefits lenders enormously. Here's what most people don't realize. Every single month you spend in the fair or good credit categories, rather than excellent, costs you money. Higher interest rates on credit cards, worse terms on auto loans, steeper mortgage rates, higher insurance premiums in many states, larger security deposits on apartments. Think about that. It's like a silent meter running in the background of your financial life, ticking every month, billing you a premium for not knowing the rules, not for being irresponsible, not for missing payments, just for not knowing. Banks profit from this extended timeline. Someone with a 680 score, who could have a 780 score, is a more profitable customer. They pay higher rates. They generate more interest revenue. The bank has no financial incentive to help that person escape the category quickly. The slow conventional path isn't neutral advice. It's advice that happens to serve everyone except you. The loophole starts with understanding what your credit score actually is. It's not a grade, it's not a moral report card, it's a statistical prediction, a probability estimate of how likely you are to default on a debt within the next 24 months. The algorithm examines your history, compares your patterns to millions of other consumers, and spits out a number. The single largest factor is payment history. Have you paid your bills on time? That accounts for roughly 35% of your score. The second largest factor is credit utilization. What percentage of your available credit are you currently using? That accounts for roughly 30%. Here's where it gets really interesting. The third largest factor is the length of your credit history. This includes the age of your oldest account, the age of your newest account, and the average age of all accounts combined. That factor is roughly 15% of your score. Most people assume credit history length is purely a function of time. You opened your first card at 18, you're 30 now, 12 years. Nothing you can do about it, just wait. Sound familiar? That assumption is wrong. And that's exactly where the loophole lives. When you become an authorized user on someone else's credit card account, that account's entire history appears on your credit report. The account's age, payment history, credit limit, and utilization. All of it gets imported to your profile as if you had been part of that account from the very beginning. Read that again because the implications are significant. If your mother has a credit card she opened 23 years ago, perfect payment history, low utilizations, and she adds you as an authorized user today, that 23-year-old account appears on your credit report immediately. Your average account age could jump from 2 years to 12 years overnight. Your total available credit could double or triple. Your oldest account history could extend by decades, not by waiting, not by spending years grinding upward, by one administrative action that takes about 10 minutes online. This is what's called an authorized user trade line. and it's been sitting inside the credit scoring system the entire time. A time machine disguised as a clerical function. Here's the kicker. The authorized user strategy isn't a secret to anyone inside the credit industry. Mortgage brokers know about it. Credit repair companies know about it. Banks absolutely know about it. But it's rarely explained to consumers because there is no profit in shortening the time people spend in high-interest territory. Nobody makes money when you figure this out. The rigged scoreboard only works if you don't know it's rigged. Now, you might be thinking, okay, but does this hurt the person adding me? Short answer, no. As long as they maintain their habits, their credit behavior continues to drive the account, you benefit from the history, you don't get access to their finances, and they can remove you at any time. Clean exit, no damage. The risk sits with you behaving well, not with them for adding you. Let me walk through exactly how to execute this effectively, because the details matter. First, the account you're being added to must be in good standing. Perfect payment history is ideal. Any missed payments will hurt rather than help. Utilization should be low, ideally under 10%. The account should be old. Older is always better. Second, the primary account holder must be willing to add you. This typically means family members or very close friends. Many people add authorized users without ever handing over a physical card. The credit history transfers. The financial access doesn't have to. Third, and this is where people lose money, not all credit card issuers report authorized user accounts to all 3 credit bureaus. American Express, Chase, Bank of America, Capital One, and Discover generally do. Some smaller banks and credit unions don't. Verify the reporting practices before executing the strategy. Fourth, the impact typically appears within 1 to 2 billing cycles after being added. You don't need to wait months or years. Decades of credit history can appear on your report within 60 days of a single phone call. Fifth, you can be removed as an authorized user at any time. The account eventually falls off your report. Low risk for the primary account holder. Clean entry, clean exit. And here's the thing most people miss. Before you go looking for this anywhere else, stick to trusted relationships. There are platforms online where strangers pay to be added as authorized users on accounts they've never touched. Some car dealerships and lenders have caught on. Some applications have been flagged. That gray zone is not where you want to operate. Keep this inside your trusted circle. The strategy is powerful enough without taking on unnecessary risk. Now let me address the question that always comes up. Is this actually allowed? Is it legitimate? The answer is unambiguously yes. The authorized user system exists intentionally within credit scoring models. FICO and VantageScore both incorporate authorized user accounts into their calculations. The practice is explicitly legal and officially recognized by credit bureaus. This isn't a glitch you're exploiting, it's a feature they built. Originally, authorized user reporting existed to help spouses build credit. One partner might handle all the finances, the other partner would have no credit history despite being part of a financially responsible household. Authorized user status solved that problem. Over time, people recognized the mechanism extended beyond marriage. Parents helping children, trusted friends helping trusted friends. The credit bureaus saw no reason to restrict this because it reflects genuine financial relationships. Worth noting, some mortgage lenders scrutinize authorized user accounts during manual underwriting. They may discount those accounts when evaluating your application even if your score reflects them. This is less common with automated approval systems. Know which system your lender uses before you start optimizing. Stick with me here because the math section is where this video earns its runtime. Let's run the numbers. You have a 680 credit score. You're buying a $350,000 home. You're quoted 7.1% over 30 years. Your monthly payment lands around $2,350. Total payments over the life of that loan, over $496,000. Now imagine you spend 90 days executing the strategies in this video and your score climbs to 760. Same home, same bank. You now qualify for a rate around 6.4%. Monthly payment drops to about $2,190. Total payments over 30 years, roughly $438,000. That's nearly $58,000 saved. On the same house, on the same income. But here's where the real math gets staggering. Add car loans. Add credit card interest. Add insurance premiums because yes, in most states your credit score directly influences your insurance costs. Add security deposits. The gap between a 680 score and a 760 score over a lifetime isn't tens of thousands of dollars, it's hundreds of thousands. The rigged scoreboard charges you a premium every month you don't know the rules. It's not penalizing irresponsibility, it's monetizing ignorance. Alright, real talk, where does your credit score sit right now? Drop the number in the comments, no judgment, I'm genuinely curious how many people are walking around leaving that kind of money on the table. It feels like you've been playing a game where the other players had the instruction manual, and you didn't. It feels like you've been charged a premium for entry to a stadium where the door was unlocked the whole time. It feels like every bank statement for the last 5 years has been slightly more expensive than it needed to be, not by a little, but by thousands. And no one stopped to mention that the fix existed. It feels like the advice you received wasn't intentionally wrong. It was just incomplete in a direction that happened to benefit everyone except you. That shift in perspective changes how you look at everything that follows. Here's the second mechanism, and this one costs people money every single month without them ever realizing it. Your utilization ratio, the percentage of your available credit that you're currently using, accounts for roughly 30% of your FICO score. The conventional wisdom says keep it under 30%. More sophisticated advice says keep it under 10%. The actual optimal target is between 1% and 3%. But here's what most people don't realize. Utilization is calculated based on the balance reported to credit bureaus, and that reporting typically happens on your statement closing date, not your payment due date. Imagine you pay your credit card in full every single month, never carry a balance, never pay $1 of interest, but you're charging $2,000 per month on a card with a $3,000 limit. If that balance appears on your statement before you pay it, you're showing 67% utilization. Your score is being penalized even though you're doing everything right. Think about it this way. Someone's payment due date is the 14th. Their statement closes on the 28th. For years they pay on the 14th, believing they're being responsible. But their reported utilization is still high every month because the balance hits the statement before the payment lands. They shift their payment to the 27th, one day before close, and their reported utilization drops to near zero. That single change, same spending, same income, same card, produces a 20 to 40 point jump on their score. Actually, let me put it this way. Go find your statement closing date for each card, not the due date, the closing date. Set a calendar reminder for 3 days before, pay before close. That's the entire strategy. No app required, no financial advisor needed. Just knowing which date actually matters. The third mechanism involves something the balance-focused advice consistently ignores. Your utilization is a ratio. You can improve it 2 ways. Reduce the numerator, which is your balance, or increase the denominator, which is your total credit limit. Most people only think about the first option. Many credit card issuers offer credit limit increases with no hard inquiry on your credit report. American Express is well known for this. You can request an increase through their app, and they'll often approve significant increases using a soft pull, meaning no impact to your score. 0. Here's what that does mathematically. You're carrying $2,000 on a $5,000 limit, that's 40% utilization. Get that limit raised to $10,000 and you're at 20% with no change in your spending. Your score improves because the math changed, not your behavior. The optimal move is requesting limit increases from all your cards every 6 to 12 months. Each increase improves your utilization ratio. Over a few years, someone who started with $10,000 in total limits could be sitting on $50,000 or more just by asking periodically. Banks don't advertise this. Higher limits mean customers can qualify for better rates elsewhere. That's not in the bank's interest to broadcast. And now we arrive at something the conventional wisdom gets exactly half right. You've heard that closing old accounts hurts your score, so the guidance becomes, never close anything. Keep every card you've ever opened, including that store card from 2019 you used once to get 15% off a blender. What actually matters is the age of your oldest account and your average account age. Closing a relatively new account might actually improve your average. Closing your oldest account would definitely hurt. A 2-year-old store card with 0 activity and a drag on your average account age? That's a candidate for closure. Your oldest credit card? That stays open indefinitely, even if you use it once a year for a tank of gas and nothing else. The goal isn't to hoard accounts. It's to understand which ones are working for you and which ones are working against you. The fifth mechanism is one most consumers have never heard of. It's called rapid rescoring, and it specifically matters if you're in the middle of a mortgage application. When you're applying for a mortgage and timing is critical, improving your score through normal channels takes 1 to 2 billing cycles. Rapid rescoring can update your score within 72 hours. Your mortgage lender can request that credit bureaus immediately update specific items on your report based on documentation you provide. Pay off a credit card balance and submit proof. The updated 0 balance can be reflected within 3 days, not the next billing cycle. Now, you might be thinking, why haven't I heard of this? Because rapid rescoring isn't available directly to consumers. You can only access it through a lender during an active mortgage application. But knowing it exists lets you time your moves strategically, make major improvements right before or during your application process, not months earlier when the impact might fade. The time machine works on an accelerated clock when rapid rescoring enters the picture. Someone who pays off a $5,000 balance mid-application can see that reflected on their score before final approval. Score jumps of 50 to 80 points during the application process itself are possible when you stack these strategies with rapid rescoring. Before the action plan, let me run through the mistakes that sink these strategies most often. And I get it. Some of these feel counterintuitive. The first mistake is choosing the wrong authorized user account. An account with high utilization hurts rather than helps. An account with any missed payments imports those negatives alongside the positives. An account that's only 3 years old provides minimal benefit if you already have accounts of similar age. Vet the account before agreeing to be added. The second mistake is applying for new credit while executing these strategies. Each hard inquiry temporarily reduces your score by 5 to 10 points. Opening new accounts reduces your average account age. People often undermine months of optimization by simultaneously filling out applications and working against themselves. The third mistake is inconsistent payment timing. Paying before statement close only works if you do it every month. 1 month of high reported utilization can erase months of careful management. Set the calendar reminder. Make it automatic. The fourth mistake is impatience. These strategies work within 1 to 2 billing cycles, but that feels slow when an application is coming. People abandon the approach before it has time to show up on their reports. Pull your credit reports 2 full billing cycles after making changes. Verify before drawing any conclusions. Now for the action plan. Tailored by where you're starting. If your score is below 650, the authorized user strategy offers the largest potential impact. Identify family members with old accounts, excellent payment history, and high credit limits. Request to be added on 1 to 3 accounts. Simultaneously, pay down any balances to below 10% of limits before your next statement closes. And pull your free credit reports from all 3 bureaus, Equifax, Experian, TransUnion, and look for errors. Studies consistently show a meaningful percentage of credit reports contain errors significant enough to affect scores and loan eligibility. If your score is between 650 and 720, you're in the optimization zone. Request credit limit increases on all existing cards. Adjust payment timing to reduce reported utilization. Consider the authorized user strategy if you have a thin file or short account history. Look for old negative items that might qualify for goodwill removal if you've had a clean record with that creditor since. If your score is above 720, you're generally fine for most purposes, but optimization still matters. Let me be specific. The difference between 750 and 780 translates to meaningfully different rate offers on large loans. Focus on utilization timing, limit increases, and maintaining patterns you've already established. And regardless of starting point, freeze your credit at all 3 bureaus when you're not actively applying for anything. It's free. It takes about 10 minutes. It blocks fraudulent accounts from appearing on your report and protects everything you're building. Here's the deeper truth underneath all of these tactics. The credit scoring system was designed by lenders to predict risk for lenders, not to help you optimize your financial life. To help banks decide how much to charge you. Banks don't explain the authorized user strategy because it helps you escape high-interest products faster. Credit bureaus don't advertise utilization timing because complexity keeps consumers paying for credit monitoring subscriptions. The industry profits from people believing credit improvement is a slow, mysterious process that might require professional help. 2 people. Same income, same job, same spending habits. One pays $200,000 more in interest over a lifetime simply because they didn't understand how the formula works. That's not a small gap. That's the cost of not having the right information. The system isn't designed around your benefit. You are the revenue source. But here's the thing. The rules are knowable, and once they're known, they can be used. The authorized user strategy isn't a cheat code. It's not exploiting a glitch. It's using features that exist by design, features that insiders have always understood and consumers were never told about. The time machine exists, you just weren't handed the keys. The gap between people who understand these rules and people who don't translates directly into wealth differences that compound over decades. Lower mortgage rates, lower auto loan rates, better credit card terms, reduced insurance premiums. The savings don't come from luck or income. They come from knowledge. A 140-point score increase in 93 days isn't a miracle. It's mechanics. The system follows rules. Those rules are learnable. The knowledge you have right now is the same knowledge that turns a $215,000 interest bill into something dramatically smaller. Same house, Same income, different information. You're not cheating, you're not exploiting anything, you're simply using features the system allows. Features that nobody with a profit motive ever had an incentive to explain to you. What you do with that information is up to you. If this changed how you think about credit scores, pass it along to someone who's still waiting for time to do the work.